Let's take a 360-degree look at one of the absolute titans of global finance, KKR. If you follow the markets, you already know KKR is fresh off a totally explosive quarter. We're talking market-shaking power moves that actually tell us a whole lot about where the entire global economy is heading. So, okay, let's dive into this explainer and unpack exactly what is driving this financial juggernaut.
Just a super quick note before we get going. This explainer is strictly for informational and educational purposes, right? It doesn't constitute financial advice. All investments carry risks, so definitely consult a qualified financial advisor before making any big moves.
Here's our roadmap for today. First, understanding KKR today. Then, record-breaking Q2 earnings. From there, we'll cover their billion-dollar power moves, unpack that $250 million settlement, and finally, wrap up with stock performance and outlook. All right, Section 1. Understanding KKR today, a modern giant.
To really grasp the magnitude of what KKR is doing right now, we kind of need to see how they've evolved. Remember, they were founded way back in 1976 by Jerome Kohlberg, Henry Kravis, and George Roberts. For decades, they were pretty much exclusively known as a traditional private equity firm. But in the 2010s, they completely flipped the script. They aggressively diversified beyond private equity into credit, infrastructure, real estate, and insurance. And now, in 2026, KKR is a globally influential alternative asset manager. They've built up this highly durable, recurring earnings base that makes them way more resilient than they ever were in those early days.
Which brings us to this absolutely massive number, $700 billion. That is the total amount of assets KKR is managing globally today. To put that into perspective, at that sheer scale, KKR isn't just reacting to the market anymore, they are literally shaping it. Their asset allocation decisions ripple through the entire global economy. And honestly, that's exactly why paying close attention to their latest report card is an absolute must for anyone trying to understand the financial markets today.
Section 2, record-breaking Q2 earnings, blockbuster numbers. Let's see what they actually reported on July 30th.
Now, what is truly wild about these numbers is the sheer velocity of growth across every single metric. Management called this a record quarter, and yeah, the math definitely backs it up. Fee-related earnings are up 34% year over year. Total operating earnings up 27%. But the real showstopper here is adjusted net income per share. Analysts were expecting about $1.43, but KKR absolutely crushed those estimates, delivering $1.63 per share. That is a massive 38% jump from last year. But listen, earnings only tell part of the story. On the operational side, KKR's momentum is just staggering. They raked in $34 billion in new capital in Q2 alone. And this part is incredible. They had previously set this wildly ambitious 3-year fundraising target of $300 billion. Well, they blew right past it in just 2.5 years, hitting $305 billion 6 months early. Add to that a fee-related earnings margin topping 70% and a wealth management division that's grown its assets sixfold, with their K-Series platform alone hitting $42 billion. Basically, they are absolutely swimming in deployable capital.
Section 3, billion-dollar power moves. So what do you do when you have billions in fresh capital burning a hole in your pocket? You go on a massive buying spree.
Let's look at how this builds, step by step, during a remarkably busy August. First, right at the start of the month, they closed their largest ever infrastructure fund at a record $19.2 billion. Then, literally on that exact same day, they announced a $5.7 billion all-cash buyout of the medical device manufacturer Integer Holdings. And as if that wasn't enough, by mid-August, reports started swirling about a massive, roughly $9 billion bid for the U.S. energy distributor UGI. We're talking 3 huge, strategic deals in rapid succession. I want to zero in on that $19.2 billion infrastructure fund, Fund V, for a second, because it tells us exactly where KKR thinks the world is heading. They are heavily focused on digital assets, specifically AI data centers and fiber optics, along with energy transition, storage, and logistics. This is crucial. KKR is making a massive proxy bet on the future of the global economy. By pouring money into the actual physical infrastructure needed to run artificial intelligence, they're ensuring they profit from the AI boom regardless of which specific tech company ultimately wins the race.
And they know exactly how well-positioned they are right now. Raj Agarwal, KKR's global head of real assets, summed it up perfectly. He said, "We could not be more pleased with the fund close in a fundraising environment where oftentimes people hear capital allocations are tight. We have grown our platform and we believe we've continued to take share." You can just hear the supreme confidence there, right? While other firms are out there scrapping for capital, KKR is actively expanding its dominance. But just when a firm seems completely unstoppable, we have to address the elephant in the room. Section 4, the $250 million settlement. The DOJ antitrust case. Right at the end of August, KKR hit a pretty significant legal hurdle. They agreed to pay a $250 million civil antitrust settlement to the U.S. Department of Justice. The DOJ alleged that KKR repeatedly violated the Hart-Scott-Rodino Act, or the HSR Act, by missing federal pre-merger filing requirements across at least 16 separate transactions. Now, this isn't just a slap on the wrist. This is literally the largest ever penalty imposed for this specific type of antitrust violation. The Department of Justice was super clear about their aggressive stance here. The DOJ's Associate Attorney General stated that this settlement sends a powerful message. The department is committed to vigorous enforcement. They are basically flashing a giant warning sign to the entire private equity and asset management space. Regulatory oversight is tightening, and if you have procedural lapses, you are going to pay for it. KKR, on the other hand, definitely pushed back on the DOJ's characterization. They stated, "We believe that our firm acted in good faith at all times under our prior filing process, and it was consistent with industry practice." They essentially chose to settle just to avoid a long, drawn-out legal fight. But here's the wild twist to all of this. While $250 million sounds like a devastating financial hit, KKR announced that the penalty will be fully reimbursed by their outside law firms who actually handled those filings. Which means this record-breaking fine, it'll have zero actual financial impact on KKR, its funds, or its investors. Kind of crazy how what looks like a massive setback just gets completely absorbed like that.
So, with all those twists and turns in mind, how is the market actually reacting? Let's get into Section 5, Stock Performance and Outlook. The market outlook as of late August 2026. Let's start with a really important metric, 16x. That is KKR's forward price-to-earnings ratio. Now, what makes this so compelling is that their trailing PE is way up around 34 times. Whenever you see a forward multiple that is less than half of the trailing multiple, it sends a crystal-clear signal. The market and analysts are pricing in some major, rapid earnings growth over the next year. And this brilliantly illustrates exactly what analysts expect to happen next. As of late August, the stock was trading around $108.50. But the consensus average analyst price target sits at $126.63. That implies a nearly 16.7% upside. And if you look at the really bullish models, like Oppenheimer's target of $166, or some of the excess return models out there, they suggest the stock could fundamentally be undervalued by as much as 25% right now. Of course, if we're being smart about this, we have to weigh the full picture objectively. The positives are undeniably strong. We've got those record Q2 earnings, $305 billion in fresh capital, a brilliant strategic position in AI infrastructure, and a stock that genuinely looks undervalued relative to its growth. But the challenges are very real too. KKR has a high beta of 1.79, meaning the stock is significantly more volatile than the broader market. Then there's portfolio risk. For example, their European e-bike company, Axel, just declared bankruptcy in August. And finally, managing and executing on all these massive multi-billion-dollar new acquisitions carries a ton of execution risk. Which leaves us with one final crucial question to consider. Do KKR's massive growth catalysts in AI and infrastructure actually outweigh the execution risks and that high market volatility? Are they perfectly positioned for the economy of tomorrow, or are they moving just a little too fast? I really want to know what you think. Drop your verdict in the comments below. And if you found this explainer helpful in breaking down the complexity of today's market, make sure to subscribe so you never miss our next deep dive. Thanks so much for learning with me today, and I'll see you in the next one.